Hey, this is Awais with OpenTrader, and this video goes over a few trade setups from Wednesday, January 16th. Now, heading into the open, we were using the 1463 to 1465 area as our bull bear zone. This was an inflection point in the market, and we were using this zone to establish our directional bias. Now, right off the open, we can see that the market opens pretty weak with the S&P advanced decline right around negative 300. This is telling us that a majority of the stocks in the S&P 500 are trading below their prior close, and the market is getting weaker, right? It shows broad market weakness right off the open. So, once we establish the opening range, 63.5 to 64.75, this is a short setup for us right off the bull bear zone because the bull bear zone is an inflection point and we're seeing broad market weakness. The NYC tick is holding below zero. So everything right now at this point in time is set up for a downside move. So this is a potential short, and the target on this is 60 quarter, and then we use the reaction at 60 quarter to gauge how strong or weak the market really is from a price action perspective. Now, once we take this trade, we can see that the push down to 1462 actually happens on a positive NYC tick divergence, right? So that's the first sign that this short idea might not play out the way that we want. The second warning sign is the rotation back into the opening range, and especially on this green bar over here on the 1 minute chart. This isn't the type of activity we want to see if we're going to get a directional move down, right? So that's the second sign that this trade might not be working out on the downside the way we expected. And the market gives you an opportunity over here to potentially either take a scratch or a small loser. And we can see that we reject the day session midpoint, VWAP, and the opening range low, and we head higher. Now, even in the event that you didn't scratch it, let's say you want to kind of let it play out and see how it goes, the market heads up, breaks above the opening range high, and that's really the third and final sign that the short idea off the open is invalidated at this point, and it's probably not going to work out. And again, the market gives you ample time to get out of that trade. Now, once we break above and then we pull back to the midpoint in VWAP, this is a potential long setup. It's not one that I personally took because overall the broad market was still showing me a lot of weakness. We weren't really seeing a lot of momentum on the tick, right? I mean, if you look over here, you can see it's printing pretty mediocre values on the upside, right? Somewhere around positive, 300-400 or so. So not really a lot of momentum on the upside, not really a lot of momentum on the downside. More indicative of balance, and it just depends on whether you felt there was enough risk reward to take this trade. On the long side, people who were bullish on the market, obviously this provided you with very good trade location. We had broken above the bull bear zone, now rotating back into it. Broken resistance was acting as support, and we also had the midpoint, VWAP, opening range high. So you had something to lean on if you were looking to take a long setup here. Again, the broad market was showing us a lot of weakness, so it was a trade that I chose to take a pass on. Now, the next inflection point was 1467 quarter to 1468 quarter resistance up over here. And if you took this long, then this is a potential target to exit your trade or at least take profit. And then once ES starts trading up here, we can see that we're not getting any follow through in momentum, right? Like on the NYC tick, we're actually getting a negative divergence, and the S&P advanced decline is still showing us that there isn't broad market strength, there isn't broad market participation in this move higher, right? And if we look at, let's kind of zoom in over here on just the S&P advanced decline, and you can see that compared to yesterday and the day before, the advanced decline is showing you a lack of participation from the broader market, right? From the broader index, from the entire index. It's showing you that majority of the stocks are not participating in this up move, and to break above 67 quarter, 68 quarter, and sustain those prices, we want to see broad market participation. So if we look at the S&P advanced decline, if we look at the NYSE advanced decline, it kind of shows the same pattern where, compared to yesterday, today we're seeing weaker internals. And even though the trend on the internals is pointing to upside, right? And we already saw that. We already got that upside move to 67 quarter, 68 quarter zone. But at that point in time, at that resistance zone, the question is there enough strength in the market to continue higher and break above and actually hold above yesterday's high? And, we felt that definitely wasn't playing out. So that was the next short setup for us over here within this zone. And then the target on the downside, the first objective is again that VWAP area and with the bull bear zone at 65. So we get this rotation down 65. Now this is the next inflection point, right? This is where buyers have a chance to step in and push prices higher. So it makes sense to take profit on your short right over here. And we've been in this narrow range, balanced type of market for over a week now. So it did require some adjustment on the type of profit targets we're looking for, and we had to adjust our aggressiveness really. I think that that's just normal. That's just a part of trading. Volatility is cyclical, and you're going to have an environment where you have wide range days, and then you're going to cycle into a low volatility environment. And once that happens, I think the important thing is that you realize it, that there's been a shift in kind of the characteristic of the market, and then you have to adjust how aggressive you are in trade entries and exits to account for that. And then once the ranges expand again, then you have to be able to shift back into that aggressive mode. And that's really one of the big challenges with discretionary trading is the ability to quickly recognize that change in the characteristic of the market and then adjust how aggressive you're going to be, how conservative you're going to be quickly, and then not really become complacent and stick with that, right? I mean, once the market changes and it starts showing you expanded ranges and volatility, then you have to be able to switch it back on and get aggressive again. So anyway, back onto this chart, we can see this is a potential short setup, and this is a setup that we took down towards 65. And then we look at the reaction off 65 to gauge how good of a setup this really is, right? Because in order for this setup to really work, for further downside, we really had to break the 64 to 65 area. And once we start seeing that buyers are coming in here, then we know that that idea is not looking as good. So let's just kind of continue on over here. Again, we saw these prices as unsustainable. We can see that the NYSE tick puts in a new high over here as price makes a new high, and then following that, there's really no follow through on momentum. And again, if we compare the advanced decline compared to yesterday, we can see that there's a pretty decent divergence between the 2 days, and we're not seeing that broad market follow through. And in order to get a sustained breakout and actually not just push higher, but actually be able to sustain those prices, you usually want to see that broad market strength. And again, on the S&P advanced decline, on the NYSE advanced decline, same picture. We weren't seeing that. And if we compare ES with NQ, a lot of times this will provide us a very good tell on direction. And we can see that as ES is putting in a top over here around 68.75, we're actually getting a negative divergence on NQ, right? Like this is holding up here and putting in a top, and we're seeing lower highs in the NASDAQ. So that also tells us that we are unlikely to get continuation, right? So at the very minimum, by watching the NYSE AD, the S&P AD, NASDAQ, at the very minimum, it's saving us from buying into the idea that this could break out to new yearly highs today, right? Like we just didn't see that scenario panning out. But at the same time, we recognize that the price action leading up to it was decently bullish, right? I mean, we were holding above the bull bear zone, so our short-term bias above bull bear is bullish from a price action perspective, but then we weren't seeing um, the broader market follow through with that idea. And these are the tools that we use on a daily basis, right? We look at the market internals, we look at volume, we compare relative volume, and to get range expansion or wider range days, we typically want to see very good volume in the market. Usually, low volume days end up being narrow range days. So we were seeing relative volume, I believe, was running right around 75-80%. So all the tools that we use on a daily basis to help us gauge market strength, market conviction, the probability of a directional move, probability of range expansion, all those things were pointing to ES topping out, right around 68.25, and really nothing else was showing us that this is going to be a sustained breakout. So again, we were looking to short this area pretty much most of the afternoon, looking for a move back down to 64.5, 65 area. And we can see it took a while to play out, but eventually, into the close, we got this move back down towards the midpoint and VWAP. And then in the overnight session, it actually worked out very well as well. Right around 67, you can see we topped out and ended up heading lower down to 60.5. We had support at 60.25, so we got some responsive buying in the overnight session, pushing prices back up. But there was a disconnect in what we were seeing in the market internals and what we were seeing in price action. But eventually, that disconnect between the internals and price action eventually resolved itself. And even though it took a while, eventually it resolved itself to the downside. And that idea of not seeing those higher prices, at least not sustaining those higher prices without the participation of the broader market, played out very well. So those were our primary trade setups from today. And aside from the morning short, the two other shorts played out fairly well. There's a 5-minute chart. So everything besides this initial short up here, which again gave us ample time to either get out at break even or take a very small loss. The other short that we got off 67.68 played out very well. Again, up here, unsustained prices played out very well, back down to midpoint. And those were essentially the main trades that we took today. Well, I hope everyone traded well today. I know this market has been pretty frustrating to trade. The ranges have been quite narrow in the S&P, and the price action has just been very slow. The pace is just not there in the market. So hopefully we see a change in the characteristics of the market soon, and we can start getting some directional moves. We've been in this balance area within this range for several days now, and we are looking for a directional move, outside of this range. And once that happens, then we'll just have to flip on the aggressiveness again, and start being more aggressive on our trades. But until then, we're going to go ahead and just focus on conservative entries, and when we get those 3-4 point profits, we're going to go and take them. And again, once we start seeing expanded ranges, then we'll just have to shift again. And that's just part of being a discretionary trader. That's actually the beauty of being a discretionary trader, is that we can make those adjustments much quicker than a automated system would. We can recognize these changes much quicker and adjust our trading accordingly. So I hope everyone trades well the rest of the week, and I hope you found the video useful, and we'll catch up with you in our next video. Take care.